Hey everyone, welcome back. After my earlier video reviewing my over $100,000 stock portfolio and how it's performed over the past 6 months, that previous video covered my performance from January through June, so this next video is going to cover my performance in the month of July 2020. I'm going to spend a little bit of time going over my overall investment strategy, and then I'm going to spend the majority of the time going through each individual company, how they performed, what they do, and most importantly, what I think they're going to do in the future. During the month of July, my stock portfolio consisted of 6 existing stocks, which were Alteryx, Livongo, Crowdstrike, Okta, Datadog, and Zoom. And then I also added one new position, Fastly. During July, my stock portfolio was up over 77% for the year and 15.19% just for the month. That was in large part driven by Zoom, which was up over 68% for the month, as well as some more modest gains in the rest of my portfolio. Like in previous months, my performance was bolstered by the effect that the global health crisis has had on technology stocks. Because of the movement to remote work, cloud technologies have become more important than ever, and companies are increasingly adopting these technologies. All of these companies that I own are in some way involved in this space, and because of that, they've seen as much as 2 years of future growth basically condensed into a couple months. This month in particular, a lot of my stocks rose in anticipation of earnings reports, which would be announced in August. With that said, I'm now going to start diving into each individual stock, talking about what the company does, why I own it, and what I think the performance is going to be like in the future. First up is Alteryx. Alteryx is a company which sells a platform that enables non-techie people to perform data analytics work, especially in large corporations. For the last several years, Alteryx has been growing like crazy, and its stock price has reflected that. Up until the end of July, this stock was up 9.84% for the month and 87.9% year to date. This stock was around 6.5% of my portfolio at that time. Now, even though this update is focused on the month of July, I would be wrong not to talk about some of the changes that have affected Alteryx since then. Alteryx released an earnings report recently which showed that their growth had slowed dramatically over the course of the last quarter, and because of that, their stock price took a huge hit. I'm not going to dive too much into details on that, but if you want, you can watch my previous video where I talk about exactly why I think that happened and what I think that means for the future of the stock. Based on that guidance, I sold a small portion of my position, but I plan on rebuying that and more once I see the headwinds that are affecting the company start to dissipate. Next up is Livongo. Livongo is a digital health platform, which means basically any kind of chronic condition which can be treated using some form of digital technology could fit under Livongo's umbrella. Now, I told you last month that this was just a small tryout position for me, and I was still waiting to see whether or not I wanted to get into the stock. Well, last month, Livongo ended up going up 91.34% in 1 month. That came to a total of 132.34% for the year. Last month, I was still trying to decide whether or not I wanted to buy more of this company, but unfortunately, before I could really come to that decision, Datadog announced that they were going to be buying Livongo in a merger. Livongo's shareholders would receive 0.592 shares of Datadog stock plus an additional $11.33 in cash for every share of Livongo that they own at the time that Datadog purchases them. While this is a pretty good compensation if Livongo were a normal company, I can't help but feel this really cuts off the growth potential that Livongo had for the future. The only reason I would have bought Livongo in the first place is because it was growing so quickly. And the fact is, I don't see Datadog growing nearly as quickly as Livongo would have. Because of that, this is not going to be a long-term holding for me. I'm probably going to sell the rest of my Livongo shares once I find a better place to put them. Next up is Crowdstrike. Crowdstrike provides endpoint protection for organizations. This stock in particular has experienced a huge boost in growth due to the number of people now working from home and all those extra endpoints that need protecting. This stock is up 17.19% just this month, and for year to date, it is up 118.44%. I am still completely confident in this holding, and I'm going to continue holding unless something catastrophic happens in the future. Next on my list of companies is Okta. Okta is an identity access management company. They basically make it easy for organizations to manage access to the different apps within their organizations across their user base. Okta is actually my only stock which performed negatively this month. It was down 10.01% just this month, but year to date it's still up 89.38%. Okta has also greatly benefited from the shift to working from home. In fact, they moved their entire workforce to work from home and didn't see any disruptions in their productivity. And over the last few months, Okta has really emerged as a leader in identity access management. I see no reason why this lead which they've developed will disappear after the large-scale work from home stops being so common. I'm continuing to hold this for now. The next holding I want to talk about is Datadog. Datadog sells software subscriptions that allow companies to monitor their applications, their security, and their infrastructure all through what they call a single pane of glass. This stock is up 10.67% this month for me, for a total of 147.13% for the year. Much like Okta, this company has benefited greatly from companies' new willingness to move more and more of their processes to the cloud. This means that those companies are less reliant on on-premises monitoring solutions and instead are looking for a solution just like the one Datadog offers. The thing is, even though companies were forced to move in this direction unexpectedly, it's not like once all of this ends, they're going to take a step back and go back to their on-premise software once they realize that the cloud is more secure and actually more economical than what they were doing on-prem in the majority of the cases. As more and more data continues to move into the cloud and the internet just becomes even larger and larger, there's going to be more data for Datadog to process, and because of that, I don't see this stock facing headwinds anytime soon. Next up is Zoom. Now, at this point, there probably aren't that many people left in the world who aren't familiar, at least somewhat, with this company. Zoom is a video conferencing platform, but it's managed to get this incredible lead ahead of competitors such as Google and Microsoft, and become the de facto standard that everybody is using while working and living in just their homes. Because of this, Zoom has become a once-in-a-lifetime opportunity where basically the entire world got on board with a single product, and that product actually executed really well based on the new demand they were seeing. Like I mentioned earlier, Zoom is up 68.97% for me just this month. And year to date, it is actually up 373.89% for me over this year. This has been my best performing stock that I have ever owned. Finally, I added one new position this month which I hadn't been in before, and that was Fastly. I bought into a full position in Fastly on July 2nd, and just this month I'm already up 41.25% in the month. Fastly offers the ability to do edge computing. What this means is computing that's done in the cloud, but as close as possible physically to where the actual user is going to be located. One example of this is a content delivery network. A content delivery network, or CDN, is basically an edge location server where a website hosts its content to make it faster for a user to retrieve that. For example, this video on YouTube is probably hosted on a CDN near to you. This makes it so that the website is actually fast enough to stream live video to you without having to wait for it to retrieve data from across the world. It's also because of this that if you keep refreshing a video and try to see the views go up, it'll only go up in batches every once in a while when that edge location is actually updated. Fastly is retaining customers at a rate of 133% in terms of their spend. This means that not only are customers not cutting their spending with Fastly, they're actually spending 33% more each year than they were before. This company continues to benefit from the growth of web content like I talked about earlier, but they're also expanding beyond just a traditional CDN and are actually looking for other applications for their edge computing, some of which may have not even been thought up yet. This is super useful in that it's going to help future-proof their technology for whatever the next big thing actually is. I am really excited about this company, and I'm just looking forward to see what they do in the future. If you add up all these different individual performances in my stocks, I am up 15.19% for this month, for a total of 77.41% year to date. Like I said last month, I don't expect this growth rate to keep continuing like it has, but I plan to hold on for as long as it will. While I thought last month that my portfolio was already up ridiculously high and there was no way it could sustain that level, I chose to hold on because I don't like to invest with a short-term attitude and like to look at the long view instead. Because I took that approach, I am up an additional 15% this month. So what should I do this month? Well, again, I think that my portfolio is a lot higher than I would really expect, and I wouldn't expect to be growing this quickly, but I'm going to take the long view and I'm not going to sell out of some short-term fear. The fact is, next month my stock portfolio could go up another 15%, or it could drop 15%. I don't really know which it's going to do, but I do know that on average it will go up more than it will go down. So I'm just playing the averages and I'm staying invested. If I had sold out of all of my positions last month, I would have been kicking myself for getting out of the market and missing all those gains. On the other hand, if the market had dropped, I would have been okay with that because I know that these are great companies and they're going to come back at some point. I also would have had an opportunity to buy more of these great companies at an even cheaper price. This way of looking at things just makes everything a lot simpler, and it's a really useful way to see things as a win-win scenario. With that said, I hope you enjoyed this video. If you did, make sure to leave a like, and if you want to see more videos like this in the future, make sure to subscribe. I'll see you next time.